Hello everyone. This is a topic on amalgamation where I talk about all steps relating to how the accounting procedures are involved whenever amalgamation happens. Now this is for those students who were not able to attend amalgamation class, or see, if you don't attend the introductory class, it becomes very difficult for you to understand the other topics. So for such students, I've attempted to make a video on this particular topic. Mind you, I will not repeat any lines, because since this is a recording, you can always go back and then play. So I don't want to repeat again and then make this video more lengthy. So I will keep it short, and then all sentences will be told only once. So in this particular chapter, amalgamation, chapter 15, from section 230 to 40 of the Companies Act 230 talks about amalgamation. So section 230 talks about compromise or arrangement. So it talks about compromise or arrangement. 232 talks about merger and amalgamation of companies, and 234 talks about mergers and amalgamations with respect to foreign companies. So let's talk about the meaning of amalgamation. Amalgamation is described as merging of two or more companies or businesses to form a new entity. It involves the following things. Either a new company is formed when two companies completely merge together, or there can be absorption, where one company absorbs or takes over the other company. So when we talk about absorption, we speak about absorption under the chapter amalgamation only. So if it is amalgamation, let's say there is one company called as X company, and there is a company called as Y company. These two company close. They close and they form into a complete new company. So closure of both the companies is very much required for it to be called as amalgamation. So only then, if a new company is formed, say Z company is formed to take over X company and Y company, then it is called as amalgamation. But what happens in case of absorption? Say for example, a bigger company. A bigger company is, there is a company called as X company. This is a bigger company. Now this company takes over Y company. X company takes over Y company, where Y company closes permanently and it becomes the part of X company. So such procedure is called as absorption. So absorption, taking over of Y company by X company, or acquisition of Y company by X company. All these things you'll be studying under amalgamation only. So when we talk about the popular examples of merger, one example is where Vodafone and Idea merged together and they formed into a V. Okay, then Aditya Birla Group, Grasim and Ultratech Cement, they merged together, and then Z Entertainment and Sony India merger, they merged together. HDFC Bank and then HDFC Limited merged together. Tata Steel and Chorus Steel merged. Reliance Industry and Walt Disney, they merged. Or Walmart acquisition of Flipkart, or Zomato and Blinkit merger, or Tata Group and Air India merger, or Indus Towers and Bharti Airtel Infratel merger. So these are the popular examples of merger. So when we talk about the types of amalgamation, there are basically two types of amalgamation. One is amalgamation in the nature of merger. Another one is amalgamation in the nature of purchase. Now there are 5 conditions which which tells us whether it is amalgamation in the nature of merger or purchase. If all the 5 conditions are satisfied, all 5 conditions are satisfied, then it is called as merger. Even if one of the 5 conditions is not satisfied, then it will be called as amalgamation in the nature of purchase. What are those 5 conditions? The first important condition is all the assets and liabilities of the transferor company after amalgamation becomes the assets and liabilities of the transferee company. Now you should know what is transferor company and transferee company. If we are talking about amalgamation, two companies, say X company is closing, Y company is closing, and they become a new company called as Z company. Now X company and Y company, both these companies are called as transferor companies because they are transferring their assets and liabilities to the new company. Now Z company is called as transferee company. Z company is called as transferee company. So the first condition is all the assets and liabilities of the transferor company after amalgamation becomes the assets and liabilities of the transferee company. And when they are transferring their assets, it has to be transferred at book value. You should not change the value of assets or liabilities. It has to be transferred at book value. If it is transferred at book value, it is called as amalgamation in the nature of merger. Now, the business is carried on by the transferee company after amalgamation, or the shareholders of the transferor company become the shareholders of the transferee company after amalgamation. And the last condition is the purchase consideration should be discharged in the form of shares, and small amount of cash only is acceptable. So major part of the purchase consideration should be discharged only in the form of either preference shares to the preference shareholders and equity shares to the equity shareholders. So if these 5 conditions are fulfilled, then it is called as amalgamation in the nature of merger. If it is not fulfilled, it will be called as amalgamation in the nature of purchase. So 5 conditions will tell us, decide whether it is merger or purchase. Even if one condition is not fulfilled, then it will be called as amalgamation in the nature of purchase. Now, in the nature of purchase, if the prerequisites for the amalgamation, the 5 conditions which I just told you, are not fulfilled, then it will be called as purchase. If the acquisition price is greater than the net asset value, the difference is recorded as goodwill. Whereas if it is less, the difference is recorded under capital reserve. I will explain this point when I explain you the opening entries. So when I explain you the opening entries, I will be explaining this point more clearly as to what do you mean by goodwill and what do you mean by capital reserve. But please note that if it is amalgamation in the nature of merger, we will not call it as goodwill only. Both of them will be transferred to reserve only. That point also I will explain when I am explaining you the opening entries. Now these are the common steps involved, whether it is amalgamation, whether it is absorption, whether it is acquisition, whether it is taking over, or any form of amalgamation. So the first step is you have to calculate purchase consideration. What do you mean by purchase consideration? Purchase consideration is the consideration payable by transferee company to transferor company. If the consideration is paid completely only in the form of shares, merger. Any other form, it becomes purchase. So ultimately, for transferring the assets and liabilities, the transferor company should get some benefit, should get some consideration, which is payable by the transferee company. So purchase consideration will be paid by the transferee company to the transferor company for transferring their company, that is for transferring their company's balance sheet, for transferring their company's assets and liabilities. So this is the first step. You calculate purchase consideration. I'll explain you the methods of purchase consideration later. The next step is discharge of purchase consideration. How the purchase consideration is discharged. Say for example, in the previous step you found out that purchase consideration was 10 lakhs. So how this 10 lakhs was paid, whether it was paid in the form of cash, whether it was paid in the form of equity shares, whether it was paid in the form of preference shares, all those compartments will be clearly mentioned in case of discharge of purchase consideration. That is how the purchase consideration was paid. Then you close the transferor company books, then you open the transferee company books, then you prepare balance sheet in the books of transferee company, because transferor company once closed will not be opened. So the balance sheet of transferor company automatically becomes the balance sheet of transferee company. So you close the transferor company books. If it is amalgamation, you have to close all the companies. So that is why it is companies if it is amalgamation. If it is acquisition of one company, then you close only one company. That time closing entries in the books of transferor company. So depending on the how many companies were being taken over or how many companies were merged, you will tell it as a singular or as a plural form. Oh, but opening entries will always be only one company. So opening entries in the books of transferee company and balance sheet in the books of transferee company. So these are the important steps in amalgamation. So these were the three important methods of calculating purchase consideration. The next step, step 2, is discharge of purchase consideration. Discharge of purchase consideration. Now, as you all know, there are three methods, though lump sum method is not called as a method. Only for understanding sake, we will look into it as a method. So when in lump sum method, we know the total PC. Total is known. Say total purchase consideration given in the question was rupees 10 lakhs. So this is calculation of PC, which you need not calculate. They only would have given you in the question. So that is why it is not called as a method of purchase consideration. In this method, if it is lump sum method, then you have to do the next step. The next step is discharge of PC. Now, how was this 10 lakhs discharged? How much cash was given? How many preference shares were given? And how many equity shares were given? But mind you, the total should be 12 lakhs. Total should be 12 lakhs. Now say for example, a cash of rupees, they'll only give in the question. Cash of rupees 2000 was given. Let's make it cash of 2 lakhs. Cash of rupees 2 lakhs was given. Then preference shares, they had given 6 lakhs. 6 lakhs in the form of preference shares. Remaining in the form of equity shares. Now we know the total. The total is 12 lakhs. Out of 12 lakhs, 6 lakhs preference shares, cash is 2 lakhs. So remaining is in the form of equity shares, that is the balancing figure. So balancing figure is 6 plus 8, 6 plus 2 is 8, 8 minus 12, that is 4 lakhs was given in the form of equity shares. So you can find out. So this is the discharge of PC. So discharge of PC basically tells you how the purchase consideration was given. So this is in according to the first method. Now according to the second method, the second method is net payments method. Now in net payments method, they would have given you completely the mode of payment. Mode of payment is known. So how much cash was given, how much equity shares were given, how much preference shares were given. You know each and everything, all the three components you know. If cash is not there, fine, it is not given. It means it is not given. So if cash, how much cash was given, how much equity shares were given, and how much preference shares were given. So you know clearly. Say for example, cash they had given 2000. Equity shares they had given 5000. Preference shares they had given 5000. So how much is the total PC? Total PC is 12,000. So in this case, you know how the purchase consideration was discharged. So in case of net payments method, step 1 and step 2 will be combined. It becomes one single step because the total, you can find out the total using the making the total of all the three modes of payment, and you know how much cash, how much equity shares, and how much preference shares. So that is why net payments method, both if it is net payments method, then both step 1 and step 2 will be merged. Now the third method is net assets method. Now in net assets method, in net assets method, we calculate PC using the formula total assets, remember, except fictitious assets. Fictitious assets meaning profit and loss account, debit balance, issue of shares, discount on issue of shares, discount on issue of debentures, preliminary expenses. All these are the past accumulated losses which you have to write off over the period of time. So those fictitious assets will not be taken for calculating the total purchase consideration. So total assets minus your outside liabilities or external liabilities. If you subtract these, if you take the difference between these two, you will get the total PC. You will know the total PC. This is step 1. Step 1. Step 2, you have to do discharge of PC. Now say for example your total assets were 10 lakhs and your total outside liabilities was say 2 lakhs. How much is the total PC? Total PC is 8 lakhs. Total PC is rupees 8 lakhs. Now you know the total. Now we will find out how the PC was discharged. How the total PC was discharged. So total you will write off. In the beginning only you will write off total is 8 lakhs. Now say for example cash 2 lakh was paid. Equity shares 6 lakhs was paid. So total 8 lakhs. So you will calculate how the PC was discharged in net assets method. So separately you will show step 1 calculation of PC, step 2 discharge of PC. That is how the PC was discharged. Okay, so this is step 2. Step 1 was calculation of PC. Step 2 was discharge of PC. I said I will not repeat, but from now on I will not repeat. Step 3. Step 3 is we close the books of transferor company. When you are closing the books of transferor company, you should make a proper distinction between amalgamation in the nature of purchase, amalgamation in the nature of merger. In this video, I am explaining only amalgamation in the nature of purchase. I will explain merger in another video so that it becomes easy for you to make a differentiation between amalgamation in the nature of purchase and merger. Now there are 13 entries. Totally 13 common entries will be made. Now depending on the information in the question, it will be lesser than 13 entries. So if that information is there, that entry will come. If that particular data is not there, then you will skip that particular entry. So but total there are 13 different entries. So the first entry, this will be there. This is compulsory. It will be there because any company will definitely have balance sheet, and the balance sheet must have the assets. So the first entry is we transfer all the assets except fictitious assets. We transfer all the assets to realization account. Normally assets will have a debit balance. Now when you are closing and transferring, you will pass the opposite entry and you will transfer it to realization account. So the entry will be realization, and entry, also remember realization account is like a nominal account. All expenses, debit all expenses and losses, credit all incomes and gains. So realization account debit to concerned asset account. I told you assets will always have a debit balance. When you are transferring it, you will pass the opposite entry. And moreover, if you open an asset account in the ledger account, your normal assets account looks like this. If it is a ledger account, you do to balance brought down. If the company is continuing, you would have written by balance carried down. But here what is happening? The company is not continuing. You are closing the company forever. So instead of writing by balance carried down, you will be writing by realization account. So that is why this entry. So realization account debit to concerned asset account, either at book value or market value. This is the first entry we post. The second entry is transferring all the outside liabilities. Now in balance sheet, if we talk about liabilities, the first liability is share capital. Next is reserves and surplus. Then all the other liabilities will be called as external liabilities. All the other liabilities will be called as external liabilities or outside liabilities. Only capital, share capital and reserves and surplus are called as owner's funds or internal liabilities. All the other liabilities like debentures and current liabilities will be treated as external liabilities. So the second entry will be the reverse of the previous entry. See, for assets account, the entry was realization account debit to concerned asset account. Now since this is a liability, the entry will be reversed. Why? You refer the assets, the reverse entry will be for the liabilities. So concerned liabilities account debit to realization account, being outside liabilities transferred to realization account. So the first one was transferring all assets. So second one is transferring all outside liabilities. Now the third one. Third one is for purchase consideration due. The purchase consideration is due from transferee company. They have not yet paid. They will pay. On why are they paying? They are paying it for the purpose of realization. So realization account is a nominal account. It's an income to us, right? When the transferor company is receiving the purchase consideration for transferor company, the purchase consideration paid by transferee company is an income. So it will come on the credit side of your realization account. Who is paying you? Transferee company is paying you. So the entry will be transferee company account debit to realization account. This is for purchase consideration due. So what all we finished? The first one was transferring the assets to realization account. Second one is transferring outside liabilities to realization account. Now the third one is for PC due. So remember it like these steps. All 13 steps, memorize and remember. If it is there in the question, pass that entry. If it is not there, omit that entry. So the fourth entry is for receiving the purchase consideration. After passing the entry for PC due, we will be passing the entry for purchase consideration. Purchase consideration may be received in the form of cash, or it may be received in the form of equity shares, or it may be received in the form of preference shares. And who is giving the PC? The transferee company is giving the PC. So for you are the transferor company. Cash is coming in. Cash account is debited. Equity shares are coming in. In which company? In the other company, which is transferee company. So equity shares in transferee company account debit. Preference shares in transferee company account debit. To who is giving the purchase consideration? The other transferee company is giving you the purchase consideration. So this is the entry for receiving the purchase consideration. So first one, repeat, assets. Second one, outside liabilities. Third one, what was the third entry? PC due. Fourth one, PC received. All these things we are doing in the books of transferor company. Now the fifth one. Fifth one, we classify the fifth entry into two categories. One is 5A and the another one is 5B. Now 5A, both these are for realization expenses. What are realization expenses? Realization expenses are those expenses which are met by the transferor company when they are realizing their assets and liabilities. They will incur some expenses on realization. Such expenses are called as realization expenses. When they are meeting the realization expense for the transferor company, cash is going out. So credit what goes out. In cash or bank account it will come on the credit side, and in realization account it will come on the debit side. So if the realization expenses are met by the transferor company, then the entry will be realization account debit to cash account, because cash is going out. But sometimes what happens, the transferee company will be so generous that they'll tell you don't meet any transfer realization expense, I will only refund it to you. You pay now, I will refund. So what happens here? You pay the realization expense in the right hand, and in the left hand you are receiving back the realization expense. So what you can do, you can omit that entry. Either you can pass one credit entry for cash going out, another debit entry for cash coming in. So simultaneously you can pass both debit and credit entry, or you can omit that. When will you do that? Only when the transferee company agrees to meet the realization expenses. So if the transferor company only meets the realization expense, it is 5.A. If the transferee company agrees to refund it back, then it is 5.B. Then you can omit the entry. No entry, or on both the sides of realization account you will pass the entry for meeting the realization expense which is met by the transferee company. So two situations for realization expense. So what all we did? We did first one, transferring all the assets. Second one, transferring all the outside liabilities. Third one, PC due. Fourth one, PC received. Fifth one, realization expense. Realization expense, there are two, 5A, 5B. For further doubts, you can refer the entries. Now the next one. Sometimes what happens, the transferee company may not take all the assets. So few assets will be kept by the transferor company. So if they keep it back, if they don't send it to the new company, they should dispose it. They should sell it. When they sell the assets for the transferor company, cash comes in. See, when you are transferred it to realization account, you are transferred it on the debit side. Now you are not transferring it to the new company. So you should pass it on the credit side. Also, when you sell the asset, for you cash comes in. So cash account will be debited, realization account will be credited if the assets are not taken over, because sometimes few assets will not be taken over by the transferee company. So first entry, asset. Second, all assets except fictitious assets. Second entry, outside liabilities. By outside liabilities, I mean except share capital and reserves and surplus. Third one, PC due. Fourth one, PC received. Fifth one, realization expenses. Sixth one, assets not taken over. Now in these 6 entries, remember, this will be there compulsorily. This will be there compulsorily. This entry will be there. This entry will be there. Now this one, depending on the question, only if it is there in the question, this entry will come. Otherwise, this entry will not come. This also, only if they have given few assets are not taken over, that time this entry will come. Otherwise, this entry will not come. Alright. Similarly, the next one. The next one is liability is not taken over. See, when you sell the asset, you get cash. When you pay back the liabilities, cash goes out. So the reverse entry of the previous one. So realization account debit to cash account. This is if the outside liabilities are not taken over by the transferee company, you should only pay. When you pay, cash goes out. Cash account is credited. Realization account is debited. So if you write all these steps, I will do it after 8th or 9th entry. So you should have already memorized by now all these 6 entries plus the 7th entry. This is for outside liabilities not taken over. Now the next entry is for closing preference share capital. Now here also 8th one will have 3 cases. Either you close preference share capital at par. or you close preference share capital at premium, or you close preference share capital at discount. If you are closing at par, this is the entry 8A. This is 8A. Next upcoming slides will be 8B and 8C. So always preference share capital is a liability. It has a credit balance. Now when you are closing it, it has to have an opposite effect. So preference share capital account will be debited. Now who will take the preference share capital? Preference shareholders will take. So preference share capital account debit to preference shareholders account. So their capital will be taken away by the preference shareholders if it is closed at par. If it is closed at premium, this is at premium. The premium amount will be transferred to realization. Normally, if the preference share capital is issued at premium, you would have credited securities premium earlier if you issued shares at premium. Now, when you are closing it at premium, the premium amount will have an opposite effect. So, it will have a debit balance. That debit balance, the amount debit balance will be transferred to realization account. This is very, very important if the preference share capital is closed at premium. The premium amount should be transferred to realization account on the debit side. Only the premium amount. Say for example, the preference shareholders were paid 12 lakhs, but they were supposed to be paid 10 lakhs. So how much is the premium? Premium is 2 lakhs. Now this 2 lakhs will come in realization account. This 2 lakhs will come in realization account. This is if it is due at premium. If it is due at discount, instead of here, the entry will come here. Rest all same. Preference share capital account debit to preference shareholders to realization account if it is due at premium. Then in this case, the realization account will be credited only with the discount amount. So 8A, 8B, 8C. So once you close the preference share capital, then you can go ahead and close your realization account and find out whether there is a profit or loss on realization. If there is a profit on realization, now if you do a ledger account, it becomes very easy for you to close realization account and find out profit or loss. But sometimes what happens in exam, they will not ask you to prepare journal, or they will not ask you only to prepare ledger. They would have asked you to prepare journal. So with the help of journal only, you should know how to close the journal entry and find out whether there is a profit or loss on realization, which I will explain when I do a problem. So if there is a profit, the balancing figure will come on the debit side. The entry will be realization account debit to equity shareholders account. On the other hand, if there is a loss, the entry will be reversed. The balancing figure will come on the credit side. The entry will be equity shareholders account debit to realization account. This is loss on realization. So this is your 9B. 9 for closing realization account. 9A if it is profit. 9B if it is loss. If the realization account tallies, then it is break even, no profit or no loss on realization. That is the 9th entry. Once you pass the 9th entry, the 10th entry, in case of amalgamation in the nature of purchases, you should transfer all insiders liabilities. See, till now we spoke about only outside liabilities. Now there are inside liabilities. Inside liabilities meaning equity share capital, reserves and surplus. Those things will be transferred to equity shareholders account. Equity share capital will always have a credit balance. When you are transferring, you should show the opposite effect. So it will be debit balance. Equity share capital account debit. Reserve always has a credit balance. Now when you are passing a transfer entry, it will be debited. Reserves account debit. I showed you why when I explained you asset account. Just I will explain equity share capital account. If you open equity share capital in ledger account, equity share capital, normally equity share capital is a liability. It will have a credit balance. You will write by balance carried down. If the company is closing, if the company is carrying on, you will write to balance brought down. You will write to balance brought down and then you transfer it and then you continue. But here what is happening? The company is closing. You will not write to balance carried down. You will write to equity shareholders account. So in equity shareholders account, it will come on the credit side. You will write by equity share capital. Similarly, instead of equity share capital, you imagine this to be reserves account. Reserves by balance carried down to equity shareholders account. Profit and loss account, credit balance by balance carried down to equity shareholder. This is the reason why these accounts are debited, because you are closing it permanently. Since you are closing it permanently, you will transfer it on the debit side. This is the entry for transferring the insider's liability, that is share capital, equity share capital, reserves and surplus, because you've already closed preference share capital. Next, see, in the previous entry we closed the credit balances. Now fictitious assets. Now fictitious assets, who will bear the losses? Holders only, owners only should bear the losses. So their account will be, debited. So you will write equity shareholders account debit to profit and loss account if it has a debit balance, to discount on issue of shares, to preliminary. This is completely reverse of the previous entry. Equity share capital account debit, reserves account debit, surplus account debit to equity shareholders account if it is a credit balance. If it is a debit balance, entry is reverse. Equity shareholders account debit to profit and loss account to discount on issue to preliminary expenses. These are the debit balances which the owners should carry and fulfill the losses. Now the 12th one. 12th one is final payment to preference shareholders. For preference shareholders, you may pay them cash or you may pay them preference shares. If you paid them cash, the preference shareholders account will be debited to cash account to preference shares in transferee company account. So they will be paid preference shares in transferee company account. This is final payment made to preference shareholders. Similarly, so the last entry, closing entry, will be final payment to equity shareholders. The equity shareholders may be paid cash or may be paid shares, whatever mode of payment will be there in discharge of PC. So there, if they are paid cash, their entry will be, cash account will be credited, and then if they are paid equity shares, you will write to equity shares in transferee company account. So equity shareholders account debit, because they are receiving cash, they are receiving equity shares in the new company, equity shares in transferee company account. So once you post all these entries, the transferor company books will be closed. So the first one is you transfer all the assets. So all the assets except what? Except memorize. Except fictitious assets. Except fictitious assets. So second one, transferring outside liabilities. Third one, PC due. Fourth one, PC received. Fifth one, realization expenses. Sixth one, assets assets not taken over. Seventh one, outside liabilities not taken over. Eighth, closing preference share capital. Ninth, closing realization account. Finding out profit or loss on realization. 10th, transferring all the credit balances like share capital, equity share capital, reserves and surplus to equity shareholders account. 11th, transferring all the debit balances of fictitious assets to equity shareholders account. 12th, final payment. Final payment to preference shareholders, and last, final payment to equity shareholders. Out of this, I'll tell you which are compulsory entries. Assets, compulsory entry. Outside liabilities, compulsory. PC due, compulsory. Every problem it will be there. PEC received, compulsorily it will be there. Then this also, if there is preference share capital, it will come, otherwise this entry will not come. Closing realization account, it will be there. Credit balances will be there. Debit balances may or may not be there. Final payment to preference shareholders, if this is not there, this will not come, preference shareholder. And then final payment, obviously without owners company will not at all be there. So final payment to equity shareholders. So these are the 13 maximum entries which you will post in the books of transferor company for closing their company permanently. Now let's look at. Now, once you pass the closing entries in the books of transferor company, you have to prepare ledger accounts of whatever entries you posted in the journal. But if you open all the ledger accounts in the looking at the journal, you will never finish the problem in 2.5 hours or 3 hours within your stipulated exam time. So we only suggest the important ledger accounts. Just because we've suggested the important ledger accounts doesn't mean the other ledger accounts are not there. The other ledger accounts are there, but only from the examination point of view, we suggest you to open only these important ledger accounts. The normal ledger accounts, in transferor company books. So these are the minimum ledger accounts. The others, depending on the information, if there are too many adjustments, you will open cash or bank account or other ledger accounts. So the first commonly opened ledger account is realization account. The next account which is commonly opened is transferee company account. The next account which we commonly open is preference shares in transferee company account. Next, we open preference share holders account. Then we open equity shares in transferee company account. And the last one is equity share holders account. So these are the normal ledger accounts. This third one and fourth one will be there only if there is preference share capital in the old balance sheet. If it is not there, these two accounts will not come. If purchase consideration has no preference shares, then also these two accounts will not come. But this is common, this will come. Realization account, you should open ledger account. Transferee company account, equity shares in transferee company account, and then equity shareholders account. And if there are too many adjustments with respect to cash or bank account, you will open cash or bank account also in the ledger accounts. Other than that, minimum these many ledger accounts we will open in the books of transferor company. The opening entries. Now which company is opening? Transferee company is opening. So whether it is amalgamation or absorption or taking over, see if it is amalgamation, imagine amalgamation is happening between two companies only. It can happen between three, it can happen between four, but it has to be more than two. So minimum two. So I will give an example of two only. If it is amalgamation between two companies, X company, Y company, both will close and they will form into a new company called as Z company. X company is called as X and Y company are called as transferor companies. Z is called as transferee. If it is taking over one big company, A company will take over smaller company Z company. So A company will not close, only Z company will close. Same with acquisition. They are used synonymously. Acquisition, taking over, acquisition or absorption. So here we pass closing entries in the books of Z, opening entries in the books of A if it is takeover or acquisition or absorption. Same with respect to external reconstruction. External reconstruction, what happens is one company, there is one company, A company, this company will close. It will close and then it will form into a new company, same company will form into a new company called as Z company. Here there is no combination, but in case of takeover, acquisition and absorption, there are combinations. But in case of external reconstruction, there is no combination. The same company will close and the same company will form into a new company. But the closing is there, that is why it is called as external reconstruction. If the closing is not there, it is completely a different chapter. It is in the next module, that is internal reconstruction. So these things will make, will tell us the difference between amalgamation, taking over, acquisition, absorption or external reconstruction. However, in all the cases, there is one company which is opening. If it is amalgamation, Z company, opening entries in the books of Z company. If it is taking over, opening entries in the books of A company. If it is external reconstructions, opening entries in the books of Z company. Here, this Z company. Alright. So, we pass opening entries in the books, that is opening. Once you have closed the transferor company books, now we open the transferee company books. So there are only 4 entries, basically 3 entries. The first entry is you are purchasing the business from the transferor company. Now what does the transferor company do? They appoint a person called as liquidator. The liquidator is responsible for closing the transferor company and transferring all the assets and liabilities to the transferee company. So when you are purchasing, now imagine you are transferee company, you are the transferee company and you are purchasing the assets and liabilities from transferor company. For you, business is coming in, so business purchase account will be debited. Who is giving you? The liquidators of transferor company is giving you their companies, so their account will be credited. That is the first entry you will post, that is business purchase account debit to liquidators of transferor company. After purchasing the business from the liquidators of transferee company, the next entry is you will, all the assets will come into the business, all the liabilities will come into the business of the new company, that is transferee company. You all know assets will always have a debit balance. All the concerned assets account will be debited. All the concerned outside liabilities account will be credited. And to business purchase account. See, in the first entry you would have passed and you would have debited the business, you have debited the business purchase account. Now in the second entry you will credit the business purchase account and then you will find out the balancing figure. If you have purchased, if you've given more for the assets of the company, then the balancing figure will come in the debit column. It will be treated as goodwill. If you have given less than the assets of the company, then it will be treated as capital reserve. Now say for example, the value of your assets is 10,000. The value of your assets is 10,000 and your outside liabilities value is, for example, 2,000 and you have paid 15,000. You have paid 15,000. In this situation, your credit total is 17,000. Your debit total is 10,000. So there is a balancing figure in the debit column of 7,000. So this is treated as goodwill. This is treated as goodwill. On the other hand, see, if your assets value is same 10,000 and your outside liabilities is 2,000 and you have paid 4,000 as purchase consideration. This is outside liabilities. This is concerned asset account. So you have paid lesser than the value of asset. So in such case, there is no question of goodwill because your asset value, whatever asset purchase consideration they paid for your value is very less. So in such a case, you will get the balancing figure in the credit column as capital reserve. So this is 4 plus 2, 6. This is 10,000. So the balancing figure is over here. Say 4,000 is the balancing figure. So 4,000 is treated as capital reserve. So either your balancing figure will be in the debit column or your balancing figure will be in the credit column. So balancing figure is 4,000. So either you get the balancing figure as goodwill or you get the balancing figure as capital reserve, or it might tally where there is no goodwill, neither goodwill nor capital reserve. This is the second entry. Now the third entry we post only if it is amalgamation in the nature of purchase, and that too if there is statutory reserve. Since the statutory reserve is a reserve created by law, by the statute, the new company should compulsorily continue the statutory reserve. The statutory reserve of old company automatically comes to the new company and we transfer this statutory reserve to a new account. A new account will be opened called as amalgamation adjustment account to the extent of statutory reserve which came from the old company. So if you have a statutory reserve of 10,000, the same amount will be debited to amalgamation adjustment account. So in balance sheet, we show this in the asset side and we show the statutory reserve on the liabilities side. Because statutory reserve is a liability, it has a credit balance. You transfer that to amalgamation adjustment account, it will have a debit balance. So the entry for creating a new account will be amalgamation adjustment account debit to statutory reserve. So this is only in case of amalgamation in the nature of purchase if there is statutory reserve. Otherwise this entry will not come. The next one is for making payment to the liquidators of the transferee company. In the first entry, you had credited liquidators of transferee company. You had credited. Now you will debit because you are giving them the purchase consideration in the form of cash, in the form of equity shares, or in the form of preference shares. So they are receiving, liquidators of transferee company account will be debited. For you, that is transferee company, cash is going out. Equity share capital is a liability, credit balance. Preference share capital is a liability, credit balance. So liquidators of transferee company account debit to cash account, to equity share capital, to preference share capital. This is the final payment made. Preparation of balance sheet. Now this balance sheet you should compulsorily prepare as per Companies Act 2013 format only, which you would have already studied in your previous semester. If you have not studied, kindly memorize the balance sheet, because when you do the balance sheet, always write off the balance sheet without writing the amounts Later on, using the working notes, calculate the different amounts and start filling it in the balance sheet. That way you will never go wrong in the format. First fill the format. Later on you can fill the amount. You will get some marks at least for writing the balance sheet. So as per format only you should prepare, and will be the new balance sheet, that is after amalgamation or after absorption, after taking over or after acquisition or after external reconstruction. So myself, Dr. Shobha Anas from Government RC College of Commerce and Management, Associate Professor in Commerce, wanted to do something for my students who don't attend the classes regularly. So when I started amalgamation, many of them were not there. So I did not want them to lose the the important topics for discussion. So if you know these theory things, then you can start with the problems easily. So you should understand all these theory part and then go ahead with solving problems on amalgamation. Thank you for your listening. If there are any changes to be made or anything, you can always meet me in my college, Government RC College, room number 104. Thank you very much.